Get called back. Let me take the call. Just get it. Let me close the door real quick. A sec. Yo, bro, you hear me good?
Yeah.
All right, let me take this call. There's a potential. I don't know if he's fucking CPA or CFO. Let's see what's up. All right, voicemail.
Valentino, hi. This is Mark Basil. Sorry I didn't pick up your call. The phone didn't recognize the number and just kind of blew it out. Apologize for that. Anyway, I'm around. Actually, the rest of the day should be good. Anytime you have time, if you want to talk, give me a call.
I'm gonna call this fool right now. Let's get it. Let's get it, Mark. Let's get that motherfucking money, boy. Let's see.
You live or what?
Yeah, bro. I'm live, bro. What the fuck? Music turned on out of. Yo, my shit ain't picking up though. My live ain't picking up. Let me see if it's streaming.
See it, bro.
Huh?
I see it.
You see it? I bet.
Yeah.
I straight.
This is Mark.
Hey, Mark, how you doing? It's me, Valentino.
Valentino, hi. Sorry about that earlier 11 o'clock stuff.
No, you're good.
I apologize.
No, you're good. Do you hear me well?
Yeah, I'm good. How about you?
I'm doing great. I appreciate it.
Hello?
Appreciate your time, Mark.
Okay.
So let me get straight to a point with you. You understand we're a startup primarily, right?
For sure.
Okay. So let's talk about compensation, which is the most important thing. Now, we plan to compensate you, and our compensation package is about $5,000 to $15,000 for assistance on the transaction, and $25,000 to $45,000 if you help with the financing. Quarterly bonuses with options for founders' equity, but all of that is post-acquisition. What I'm trying to say is we can't pay you right now, but we will. Don't get me wrong, this is not a charity or a nonprofit. We don't want anybody to work for us for free because, that's how mistakes are made. What we're looking for is people.
Yeah, sure. Yeah,
right.
If somebody works for free, you'll get what you pay for.
Oh, no, absolutely. You get what I'm, because they're not going to have the same enthusiasm or level of detail when it comes to being a part of things. But what I want to tell you, though, is we're looking for people that can just give us 1 to 2 hours a week right now, starting out. Okay. Depending on the individual, I might need more time, but on average is 1 or 2. Now, Mark, I understand your biggest concern is going to be the level of risk that is involved. Because we're a startup, we can't pay you the risk a lot. But I'm not asking you to come in full level. Basically, I'm gonna de-risk it for you by having you being involved as minimum as possible. So because I'm doing the roll-up sleeve work, I'm reaching out to the sellers, I'm cold calling them, I'm emailing them, I prospect, I negotiate, I structure the deal, walk the facility, see what the culture of the company is. I'm gonna do all that. But throughout that time frame, I'm gonna get with you more or less for some small advice, right? But primarily, I'm gonna come with you once we have a solid LOI, something tangible, because you and I both know what anybody cares about, banks, investors, you name it, is something tangible and signed, an LOI at least. Right. So that's how I'm gonna de-risk it for you. Is that something that works?
Yeah, I've got a couple of those going on right now where it's deferred comp type thing.
Yeah.
And they're, like you said, they are kind of risky, but that's okay. It's not I've got a day job, so to speak, and right. I can definitely absorb a couple hours a week.
Perfect. So let me talk to you about the project. So start talking about this now. To share with you a little about my experience, Mark. Last year, I was working on doing a roll-up in the senior care industry. It was mostly care homes and real estate-based businesses. Now, due to COVID, that wasn't a good option because we weren't allowed to get more seniors into a care homes. It was a health risk. Now, I learned a lot. I mean, what to do, what not to do, how to negotiate, what they look for, what investors want, how to analyze and evaluate businesses, the whole process. So, I say I'm coming in with a plan in hand. Now, two major things I learned that made me switch into doctor and physician offices. First of all, is real estate based businesses are limited by the size and the rooms of the building. This won't allow exponential growth. That's why I'm going towards service based businesses, because we can market it. We could get more patient flow, more people. Now, another thing that is key is people are more willing to purchase multiple services from one trusted provider than just one and figure out the rest. And this is where I came up with the idea of creating a one-stop shop in the healthcare industry, what I would call, Mark, the circle of life operation. Now, from my bio, if you read, I'm focused on doctor and physician offices to start, right? I'll tell you why.
Right.
Now, a couple reasons why this is going to work so well is, first of all, is social capital. Instead of creating from scratch, we look to leverage the social capital these doctors have with their patients to offer them more services. Second is physician growth. These larger doctor and physician offices have spare rooms that are not in use. What we can do is bring in other physicians that work in conjunction with the services being provided to have multiple services under the same roof, essentially a multi-physician model. Now, the approach will be that the physician will be paid on a performance basis, and he brings his own patients. This is how we won't incur massive payroll expenses. Third is image and perception. What does a person that move into a new city look for? Reviews. A lot of these offices don't have 5 stars, maybe don't have 5 stars due to reasons we can and will fix. So acquiring them gives them a second chance under a new name and image. Fourth is marketing. I've spoken with many business owners, and they tell me they rely usually on word of mouth. Now, we want to implement a marketing strategy to bring in patient flow. And the major question, Mark, why should they sell to us? First of all, we're offering them the ability to retire. From what I know, these smaller practices, usually the doctor or physician is the business, right? So they're tied to it. We're offering them the option to be part of a network of doctors where they don't have to worry about patients. They could be a part of the growth without being the one shouldering responsibility, and access to latest technology and equipment to maintain a competitive edge. In essence, we're offering them safety, security, expansion, and the option of retire later down the line, thus benefiting them and the patients. Now, from this, do you have any comments or questions?
No, I had a couple partners at one point. We looked at some senior care facilities, did a little bit of due diligence, but we never pulled the trigger. And some of the limitations you mentioned is what we ran into. Definitely the real estate footprint and
yes,
things like that. So it was not, the sellers wanted top dollar.
Oh, absolutely.
The beauty of it all.
No, I was looking. Look, Mark, I was looking at this one facility. It was in San Diego.
Yeah.
They were asking for $50 million, and it was only doing $1 million real estate. It was because of building. That's not gonna work.
Yeah. No, we looked at the same thing. It was just briefly. It was just I was looking at it like a suite of businesses, and that was one of them. And so we didn't really take it further. So I don't know too much about it. I mean, that was about the limit of it, but I just saw that there was definitely a
there's a cap for sure
to get in.
Yes.
Yeah, and there was a cap. There's definitely a ceiling there, and in terms of being scalable, it was, but I mean, there was a massive upfront investment to scale it out, and that's why we never did anything with it.
Not only that, there's two ways to grow. There's growth through investment, which requires capital, and then there's growth by doing more work. And that's more of growth with capital. You need to expand the building, and if you expand the building, you're bringing in debt, and then the new patients that would come in, or the new seniors or tenants, they're already servicing that debt. So what do you got? 5%, 10% profits on it? Makes no sense. Yeah. So I saw doctor and physician offices as the best option. Why? Well, first of all, every doctor, they're in their corner. They service the people around them. These guys is usually the doctor, maybe a technician or an assistant. They don't have options to retire. They are the business. They're so bogged down working in the business instead of on the business. And let me share with you the overall vision I have, right? I'm looking to have a synergistic platform of doctor and physician offices throughout the nation. We're going to do it on a city basis. I got a 10-year time frame for this. What we're going to look to do is acquire the majority of doctor offices, physician offices, and create a network. Now, we're going to have a doctor office every 2 to 3 blocks. The patient would come in, they'd get checked in. That will serve as a lead gen system. We will have blood work analysis done to see if there are any current or potential health issues, and then we would refer them to our nearest doctor and physician. They could book a date on our app, so they just come in and out, no waiting or delays. So for our acquisition criteria, we're interested in community doctor and physician offices between 1 to 10 million annual revenue. As we know, it usually consists of a doctor, a couple doctors, and assistant. And we will look to implement a one-stop shop model where we establish a brand for the patients that they can trust, and we're allowing the doctors the option for growth. Health is critical, and you putting your life, especially major organs of your body, on the hands of somebody you don't know, that's risky. So that's what we're looking to do, create trust for the patients. You get what I'm saying, Mark?
Yeah. So are they like like neighborhood facilities? Are they going to be like targeted to low income areas, or what's the strategy there?
Now, primarily, I'm looking at. We got both options, and I'm looking to speak with somebody regarding this. There's private pay, and then there's government pay, which is Medicare, Medi-Cal for California, and other options.
Right.
I'm looking mostly towards private pay, with the minority being government pay, because we want cash flow. And not only that, we want dependable cash flow, right? Government changes regulations, that affects us. So I'm looking to start on higher neighborhoods first and then expand to lower income neighborhoods. But the business tells it all. The business, the numbers speak, and it has a story. As long as we stick to our range and we meet our financial criteria, we should have something solid. But not just that. I'm looking to expand later into preventative medicine. I'm looking to get into clinical research organizations, medical laboratories, death care, what I call the circle of life operation. I want our patients to be able to entrust us from the birth of a child to their burial. And if we could create a model like that in just one city, we could either sell it to be replicated on a larger scale, or just take it public and get all the funds and take it to a larger scale.
On the private pay side, though, I mean, how does insurance factor in, especially in a place like California where everybody has insurance?
Right.
I mean, how much private pay patients are there?
I'm gonna tell you this: I am in California, but I'm looking to move to Florida in the coming months, around ends of the year. So I'm looking at businesses in Florida. I'm not trying to get some California taxes. You get what I mean? That's going to affect us definitely.
Over. I mean,
yes,
it's definitely, there's a population here, but in terms of if you start making any real money, you got to get out of this state.
No, absolutely. I'm moving to Florida, neighboring states. Yeah. Regulations. We want freedom. That's what we want. We want the ability to conduct business and do it right.
I'm advising people that there's some of the startups and all that. I'm like, well, don't do it in California unless you need to.
Right.
No, I'm telling go to Florida, Texas, Nevada.
Oh, absolutely.
Tennessee.
Absolutely. Yeah, those are great states, and those are states I have in mind.
Yeah.
Oh no, it's just getting worse. I'm seeing, states on that end they're doing better, and we just want to stick to what works. That's working. We move there. Simple. Like I say, it's the same country anyways, right?
Yep.
So, Mark, give me a little snapshot regarding yourself and your background. A little 30-second, 1-minute snapshot.
Started as Big Four CPA at EY many years ago, and I came up through the audit ranks, and then from there worked, I guess initially for my clients for a lot of years, either as a CFO or for a CFO. Did a lot of M&A work for the most part. And I guess on the other side, I did quite a bit of operations experience on warehouse distribution, that type of thing. I
Yeah.
don't have much healthcare experience, but in terms of what's relevant here, looking at deal structure, M&A work, and then even the post-acquisition integration, which is what I'm
Perfect.
mostly doing right now, doing work for PE firms out of New York.
Right.
We just bought a couple health and wellness companies locally, so helping getting them set up, with the new owners and
Yeah.
kind of a new team, and bring them from kind of the dark ages in terms of accounting and finance and into current times.
Oh
So
no,
that's the 30
absolutely.
seconds.
Oh, that's perfect. That's perfect. That's why I reached out to you. Based on your background in finance, and I also saw you were with Ernst and Young. Uh, Now
Yep.
let me ask you this: how would you think your experience can contribute to the success of this company, and how do you see making a positive impact out of it?
Yeah, well, really just looking at the deal analysis and, helping you solidify a strategy. I mean, it sounds like you've got some things in place, but, that may change over time. But
Absolutely.
helping put numbers to your strategy, and then on a micro basis, as if you come up with deals,
Yeah.
that's kind of in my wheelhouse to look at that, and, in terms of how to structure that. And,
Right.
and even before structuring the whole due diligence process,
Hmm.
figuring out what that thing is worth and whether it makes sense to buy it or not, I can help you with that.
Perfect. Now, one thing I noticed, if we could talk a little about finance, one thing I noticed regarding small businesses is that they're not audited. Numbers are not audited. So, from what I know, we want to have past 3 year financials. We're talking about profit and loss statement month by month, and balance sheet and taxes, and basically check between them
Yeah.
and find any red flags. Correct?
Yeah, no, you got to beat those things up, and usually you start also tax returns. For the most part,
Yeah.
I've yet to see a small business owners that's not a tax cheat.
Yeah.
So they
Oh, wow.
it can be tough. So you got to look for other clues, and
Hmm.
like for instance, you go look at a coin laundry. You're obviously not going to believe their receipts or anything that
Right.
they claim to be receipts. So you look at bank statements, but you also look at things like power bills. Kind of corroborate the whole deal. So, I
see.
can't give you an example that's directly analogous in what
Right.
you
Right.
guys are doing, but, you, every seller I've known is kind of, cook the book, so to speak, when they go to
Right.
sell a business. So that's
And
just
that's
standard course.
exactly what we want to prevent or mitigate. And what I do have in
Yeah.
mind after the acquisition is have those financials audited. We want to keep a clean slate for the investors, right?
Yeah, no, and it takes a while to even get them to be audited or to be in shape to be audited. So it's not as if you just hired the firm to come in and audit the books. A lot of times there's nothing to audit, or there's just bad records. So you got to build all that stuff. And also
Right.
part of the deal, I mean, if there's anything that you're really concerned about, you typically keep, a percentage of the deal for a contingency type thing, or,
Right.
subject to an audit or some numbers being verified. And if they're short of that mark, it's a dollar for dollar payback to you as the buyer.
I see.
They're representing that a balance sheet is of certain kind of condition. So that's all part of what you put in the deal. And if they're unwilling to do that, then, run, because there's something there that
Right.
does not meet the eye, and they're trying to
Right.
hide something.
Absolutely. Now, my experience speaking with plenty of business owners, I've noticed something. People who are interested in selling are usually on the desperate side of things. They want all the money up front. And for our model, those are not the people I'm looking for. I noticed there's 3 reasons why someone sells, Mark: time, money, or expansion. And we're interested in people who are looking to retire or people who
Yeah.
are looking to expand. Why? Because we can incorporate
Yeah,
a portion of seller finance.
Yeah. No, if someone, it's kind of a no-brainer, but yeah. So when I look at business, I always try to find seller financing, because they're not trying to like cut and run. If they're
Right.
willing to have, again, part of their deal based off of the future earnings of the company, I like that, because, they see it as a going concern. They see, it implies that there is some value that they're selling there, because otherwise they're left short and they're not going to get paid out. So stuff like
Right.
that is always encouraging. The other thing you got to watch out is for, non-compete, that type of thing. If somebody opened up shop across the street and they want to get top dollar for this one, and they're in place,
Yes.
to bring all the clients and customers to the new thing. So that's tricky, especially when you get into like smaller businesses. But
Right. No, that
I
makes
don't know if
sense. That
that
makes sense.
applies here or not.
Now, myself, I studied financial analysis, valuation. I created a whole little Excel spreadsheet that I'm able to do the balance sheet. I'm able to do profit and loss. I'm able to do pro forma up to 5 years, discounted cash flows. So I could run the initial analysis on the deal, and then I could bring it to you so we could double check and make sure uh,
Sure.
the numbers are stacking up. That will save on your time, and the information already comes organized, and you can immediately see from your experience what works, what doesn't. Is that a good option?
Sure. Yeah, that makes sense.
Perfect. Perfect. Great. So we're looking for people just like you. I just want to know what you think. Is this something you can do, Mark? We're looking for non-executive directors, of course.
Yeah, no, I can help you out. I've got the capacity to do it, I guess. It's been super busy, which is great. Like when COVID first happened, I went through like a month there where like all the investments shut down. Everybody pulled back, as you remember.
Wow. Yes.
Nobody knew what was going to happen. So, all the deals stopped being funded, and it was not good for a while. But since then, the economy is just like going nuts. And
Yes.
it defies all logic and explanation. But I don't know. I think we're headed for a fall at some point. But right now, I'm turning down work, so that's good.
Perfect. I got a question for you, Mark, very briefly. Now, we're already in first quarter 2021. Let's say, and people in 2020, they were mostly home. So I've seen there was a spike in growth or cash flows for the first quarter now that everybody's able to come out. What if I saw this situation on a deal on a buddy of mine, and I want to see your input on this because we're going to come up with it too. We're going to see it. But he had come to an agreement of $4 million based on prior year financials, right? Now, the guy made, I think, $1 million for first quarter, and he suspects or projects he's going to do $1 million for the next 3 quarters, so that's $4 million. And he's looking for 3 times, so that's $12 million. So he went from $4 million offer to now $12 million supposed projected offer. I want $12 million because we're looking to do 4 by this year. And there's only 1 quarter of data. How would you approach a situation like that? Because I know that's super risky.
Yeah. It really depends on how much you believe that trend is going to continue. And it really depends upon what it is. And I know you don't want to hear this answer, but it's arguably is worth the $12 million if, in fact, that trend will continue. The 3X factor is pretty common. Obviously, you try to get it cheaper. But, it may be some legitimate thing. So what's the reason why it went from $250 a quarter implied to $1 million a quarter? What happened? What changed with the business?
Well, last year it was 2020. It did 1.4 net total.
1.4. Okay.
Yeah. What we suspect is due to people being at home and now being able to go out, it spiked the growth. So I'm thinking second quarter is gonna level itself out. Right. Now the problem is we don't want to wait till the second or third quarter to have enough data to say, hey, you're wrong. They're already in contract. They're looking to move. So what they were thinking is agreeing on the $4 million down and doing a clawback for the other amount. If it reaches those numbers, then he gets paid that amount. If not, then he doesn't. But what gets financed is what they know for a fact.
Yeah, that's what I was saying. I've very seldom been involved in a deal that didn't involve some kind of earnout, to the side.
Right.
So that you guys are both invested in the purported projections of the company. So it's kind of what we said earlier. You can pay him that $12 million base or whatever you come up with, provided that the numbers are met. So, yeah, you don't have to structure it all up front like that. So it could be like a 2-year earnout or anything like that.
Okay.
But I'd be more just like you said. I just in terms of the economy, I suspect that we're going to have a wild rush this year in certain facets of the market, with people just getting out that are kind of pent up demand. Right. And then I think we'll kind of level out and return to, kind of a little bit more normal. But
Right.
people are going ape shit trying to get out and like travel and all that sort of thing.
No, of course.
You're squeezing like 2 years demand into like a summer right now. I just
Correct.
recently booked some travel, and I mean,
Uh-huh.
the days of cheap travel are over. Flights
Oh,
are way
wow.
up. Rental cars are way
Skyrocketed now?
up. Yeah, it's getting pretty expensive. I mean, fuel is up,
Mhm.
gas is up,
Yeah,
and
oil,
and we
yeah,
haven't
all of
even
that.
reached capacity quite yet. I think we're still about 15%. I think this last weekend they said travel was
Oh,
about
wow.
15% under the trend. So we're still not quite back yet. But anyway,
Well, what
so
what I have
yeah,
in mind,
if you
Mark.
can structure out an internet.
Uh-huh. Now, my concern
Go
is because we're going to be using commercial funding to finance these transactions alongside investor funding. My concern is making an offer and then next year we're not hitting those numbers and now we're short.
Well, I think you could structure it based if you feel confident. Look, it's always a crapshoot no matter what. But if you feel confident that it could at least earn the trending 1.4, you could provide it based off of that. I mean, you could structure it around that kind of thing. So that's roughly a little bit under your 3x factor on the 1.4. You said 4 million. That'd be
Yeah.
5.2 million. But the rest of it can be, some form of an earnout. And if they're not willing to do that, maybe they're not. And
Right.
you miss out on the deal. But it sounds like you guys are not able to absorb a $12 million purchase price versus 5.2. Sounds like you're not able, or 4, whatever it is. Sounds like you guys aren't able to absorb an $8 million bad guess.
Mhm.
And that's fine. So, I think
So the way he was
best way to
approaching
do
it,
is
it was an earnout on defined EBITDA targets. So 80% and
makes sense.
100%. If it dips below the 80%, he gets nothing. Because he's betting, hey, I'm certain this is the projections we're going to get. So that's how they're going to do it. Okay, you're
Well, in that
certain?
case,
Just
I
put
mean,
on an earnout.
also, exactly, because otherwise it's like, why does he need to sell? I mean, why doesn't he wait a year and then he will get that 3x, with a little bit more history behind it and an uptrend like that, then he'll get it. So if he really believes that's going to happen, he should be okay with the earnout. At least he gets, he doesn't get the money up front, but he ultimately gets the value, with a little bit less risk on his own, because in the end, look, if he gets back to the 1.4 level, his company's only worth 4 or 5 million anyway. So if he wants to get his money, I don't know. It depends on what it is. Like a lot of times in the startup world, you get these, deep pocket companies that, well, you've seen it. They'll pay $200 million for a company that's losing money. But if it's a complementary product to what they're offering, or they actually see the potential, or they have enough faith in those founders, you can do that. But I think from what you're talking about, that's probably not necessarily that type of thing.
No, it's just a medical practice, local medical practice.
Yeah.
They got a spike.
Exactly. Yeah. This is not, it's not Uber, I mean, it's not a new idea or anything like that. So, so especially if it's that kind of thing, you got to really wait and see and or defer his compensation based off of the future earnings that he's purporting to have. And so
that makes sense. Now, let me ask you this regarding, and I've heard different insights regarding cash flow metrics for small businesses. What do you say is the best? I've heard people say EBITDA, but then they've also told me EBITDA takes into account expenses that small businesses account for, meaning taxes, depreciation, amortization, and others.
Well, EBITDA is earnings before interest, taxes, and depreciation. So it's the surrogate for cash flow. In the end, you always want to come down to cash flow. Everybody wants to know what it throws off in cash. Meaning, nobody cares about depreciation, which is a non-cash charge. It's an earnings hit, but it's not cash out the door. It's amortization of prior funding that you did on assets. So so cash flow and it's like DCF, discounted cash flow models are usually I guess the best for small businesses. So you just plug in your required rate of return and you discount all the future year's earnings and come up with the present value, and that's how you value it, on day one.
Okay, perfect. Because I
So
was
cash
running
flow,
analysis on
and
a
again,
deal.
EBITDA, it's
Uh-huh.
uh-huh.
No, sorry, finish.
So it's kind of the same thing. So EBITDA and cash flow are kind of the same thing. EBITDA is just kind of a again, I'll call it a surrogate for
Right.
cash flow. Because
I've heard they say a
looking at
proxy
earnings and it's
to
removing
cash
all the
flow.
non-cash charges.
Right. So
Yeah.
I saw this one deal, and let me share it with you. It was analysis I did for my studies, but it was
And Valentino, one more thing. And also,
yes.
wait, one more thing. Also, free cash flow is an important thing, because free cash flow is an even better number. It's like a higher order number, because what that does, it takes out debt service. So you can look at the true cash return on the business after.
That was exactly what I was going to tell you about. That was exactly
acquiring it. So
right.
They're both in the same ballpark, but one's a little bit more informative than the other. And the reason that you'll see EBITDA, it's a true measure of the business. However, free cash flow is a measure of the business less the measure of your ability to get it financed. So it's like it's a little bit of a hybrid thing. It's an apples and oranges thing.
Right. Now I saw this one deal very quickly. Let me pull up the numbers to get your insights on it. It was analysis I did for my study, but it was saying 2020 did $208 million revenue, right? Now EBITDA was $29 million. EBIT was $23 million. EBT was $20 million. Net income was 16. NOPAT was 18 million. NOPAT minus CapEx was 16 million. Unlevered free cash flow was 2.5 million. And net cash flow was negative 11 million. So from all those metrics, what would I approach?
Yeah, I'd have to go back to free cash flow. It depends. So here's the thing: if you're acquiring a business that has existing debt service, you got to look at free cash flow, unless at least for near term, until you can restructure the financing on it.
Right.
So
now I came up with a little hybrid. I call it true free cash flow, and I'll tell you what it is.
Okay.
And you correct me.
Yeah.
So I got NOPAT, which is net operating profit after taxes, as my base. Then I deducted investments in working capital. Then I deducted investments in other assets and liability. Then I deducted capital expenditures without depreciation and amortization, because NOPAT already removes it, so I don't want to double deduct. Then I deducted other investments, and then I deducted extraordinary items, and that gave me the number of 7.7 million. And NOPAT was 18.7 million.
That's a good method. It depends also on, like, if a business is like asset intensive, and if they have assets that are kind of end of their life cycle, they may have like a great cash flow, but they've got this looming $50 million expenditure. So so you got to factor all that sort of thing in as well. It's hard to give you like a blanket answer. It really depends on
of course.
The business.
Yeah, when the time comes, we'll analyze them.
Makes sense.
Okay, perfect.
Yeah, sure.
Now my question, and a guy told me this: if I buy a business, so there's asset purchase and there's stock purchase, correct? If I do a stock purchase of the company, I get all the assets wedded, and the value would be based on a multiple of the cash flow. Why would I get the assets and not pay for them? It's because the assets is what is used to generate the cash flows. That means I cannot make an offer on it, and then I'd have the assets or the equipment I need to generate it. Because then I'm buying an empty company, right? As
a general rule, sometimes you'll see asset deals done, and the reason a lot of times it's done that way is there's some existing liability. So when you buy the stock, you're buying the company, both the assets and the liabilities.
Correct.
So if you've got pending, threatening lawsuits, that type of thing, you take that on unless you carve it out as part of the deal structure. So that's why a lot of times the company will retain that liability, so to speak, and kind of screw the existing shareholders, but they'll generate a sale of the assets, and it's not even fair to say screw the shareholders, but you know what I mean.
Yeah.
I know. They're going to get.
They hold the shell. They hold the shell.
Asset, and yeah, and they want to unencumber that asset, and the highest and best use, and quite honestly, the best return for the shareholders could possibly be, selling, an asset, and that could be a tangible asset, equipment, or it could be something intangible like a customer list or customer base, that type of thing.
Now, there's a thing about
that's
it,
why
though.
you'll see,
There's a problem with doing
deals
the
tend to
asset purchase. So when I do the asset purchase, and I spoke to a bank about this, and I'd have a new entity to acquire those assets, the bank registers it as a startup because it has no history. And banks need 3 years minimum to finance. So what a guy told me is you could buy a shelf company that has been filing taxes, and you could get a 5-year one to acquire the assets. And then you could show, hey, we've been filing taxes for the past 5 years. We're good to go. Is that something we could do?
Yeah, and I'm not a tax expert, and I don't even claim to be, for sure. But yeah, I've seen deals structured like that, especially on the smaller ones. I mean, there's definitely kind of like smart loopholes in the way to structure that.
Right.
So yeah, I've seen shell companies, for sale that have been filing taxes that don't have any stink to them.
Okay.
And
last thing, real quick.
To be the acquisition company.
Right. Last thing, real quick, is regarding the asset purchase. Would I make my offer the same as on a stock, a multiples of cash flow?
Yeah, I think so. I mean, I'm trying to think if there's anything that. Yeah, it'd be the same thing. I mean, because a lot of times the assets, I don't know, they could be overvalued, undervalued, whatever you want to call it. So it's
depreciated
not
assets
based off of.
Yes.
Yeah, it's not based off of any book value of assets, unless I mean, if you're buying like a dry cleaning plant or something, there might be something like that. But for what you guys are talking about, the asset purchase is not going to be. Yeah, I mean, you're going to have way more value. You're really going to be buying the annuity of the of the network, so to speak, and it'll be based off of some formula of cash flow.
Right. Do you have any experience working with investors, Mark?
Yeah. I mean, they've kind of I mean, they've ranged from I've done some private deals with I guess groups. I've got some contacts at in Morgan Stanley. They're actually going to break out and do their own company, so they can actually get more into the investor side. Yeah, I know it's good timing for me because I'm looking at businesses myself.
Right.
And,
that's perfect.
So they've got they've got a couple billion of like clients that they're going to take over, which is not a lot actually in their world, but
okay.
So yeah. So now they're going to I've been talking with them like let's get this funding arm set up, because you're not confined by Morgan Stanley. Morgan Stanley, they can only sell like essentially Wall Street products. They can't even put their clients in like real estate deals or any kind of like private equity deals or anything like that. But now they're going to be able to do that. So it's just, we've been working on this for 6 months, and I think they're finally going to open shop here in July.
Perfect. Sounds great. No, from the conversation I just had with you, Mark, looks like we're both on the same page. Would you agree?
Yeah. So for sure, I could help you with the valuation stuff. And if you've got any kind of white paper or anything like that you want to send, and I'll sign an NDA or whatever you want to do. But if you got anything written down that I can take a look at,
No, absolutely. So as of right now, just to give you a heads up, I'm just finishing the team so I could get on with deal flow. So I'm gonna send you over our copy of executive summary, and I'll send over an NDA. And if you could send me just a bio of yourself in a picture,
sure,
so I could upload to a website, and we're good to go. And I'll keep you in the loop. Sounds good?
All right, sounds good.
I'm also thinking we're gonna have our first board meeting once the team's complete. So I'll give you a date, and we call hop on and brainstorm.
Sounds good. Okay, yeah, send over what you got, and I'll get on that this week. So
okay, I got you. Thank you very much, Mark. Take care.
Thanks. Okay.
Bye. Damn, bro. Come on, man. Too easy, bro. Too easy. Let's get it. Now, guys, this was just the first guy, CPA. I mean, CFO. We already got him in, CFO. I'm going to send over an NDA. I'm going to send over information. This was two sides, Nancy, so they could hear the conversation. But this is just to show you the other side of the conversation, meaning the next videos, you're not going to be able to hear it. For you to hear the other side, you're going to have to join the private Discord group. So I'll put a link on there so you guys can join and you could get on it. So I'll let you go. Peace.